Hello, everyone, and hope everything is fine and great at the last day of this trading week. So, I'm Ahura. Will be with you to review the US inflation data and see how markets reacting to these data. First of all, as we know, the PCE price index and the core PCE price index they are the US Federal Reserve main inflation measure that you're looking at that when they are talking about when the Federal Reserve is talking about the inflation, they mean these numbers, core PC price index. I mean that's the main important, the most important data that you're looking for. PC price index increased by 0.1% monthly, and core inflation increased by 0.2%. PC price index was in line with expectation, but the core PC it was above the expectations. We were expecting, the market was expecting around 0.1% market inflation to increase, but that increased by 0.2%. On the annual scale, core PC price index increased by 2.7%, a little bit above 2.6%, and headline inflation increased by 2.3% in line with market expectations, but a little bit higher than 2.2% that we had in April. But the market surprise was not that. The surprise was here, the personal income and spending. The income, after several months of great increasing of 0.7%, 0.8%, 0.9%, this month, while we were expecting 0.3% increase, that fell by 0.4%. At the same time, the spending also, while we were expecting 0.1% increase after 0.2% was that we had in April, fell by 0.1%. That means that the people or the consumers, they have less income and they're spending much less. So they're a little bit more conscious about what they are doing, which means that the market risk is a little bit increasing while the inflation is high. So that put actually the Federal Reserve in a crossroad, because the weaker labor market data means that they have to cut the rates. Higher inflation means that they have to wait a little bit more. But with the ongoing weakness that we see in the economy, yesterday also, we had more data from the market. Oops, here we go. Yesterday we had the first. Let's make it a little bit. We had the GDP numbers and the same personal income spending data for the first quarter. Here we go. Yeah, here are the data that we had yesterday. So with the data that we had yesterday, we can say that the core core PC price index increased by 2.7% in the first quarter. Let me put the screen going here. Yeah. Core PC price index increased by 2.5% in the first quarter, which means that the inflation is still the main, should be the main concerns for the Federal Reserve. While at the same time, we can see that the GDP also fell by 0.1%, 0.5%, a little bit more than 0.2% expected fall. You know that at the first estimates, we were expecting 0.3% GDP fall. Then it came to the 0.2% for the first quarter, and then at the second review, that's the third revisions of the GDP growth expectations, and that's fell to 0.5%, which means that the economy is moving weaker. Labor market is getting slightly more under pressure. Initial jobless claims what fell to increase by 236,000 in previous week, which means still fine. The labor market means still fine with the 236,000 apply for unemployment benefits, but still it's much more than 220, 15%, 15,000, 220,000 that we had previous months. The 4-week average also for the apply for the unemployment benefits also increased to 245,000 compared with the several months ago, which it was about 220, 230,000. So while the labor market is weakening, at the same time, we know that the income also is getting slightly weaker. And jobless claims also from 1 million, the continuing jobless claims also increased to 1,974,000, as you can see here. So all these data says that while the inflation is still the concerns, but we have a bigger concern, which means that economic growth. This economic growth means that we have to be more cautious about the Federal Reserve decisions, and the Federal Reserve more probably will get more pressure on increasing on rate for the rate cut. Let's check the CME Group FedWatch tools and see that what the CME Group FedWatch tools is telling us. After these data, we can see now that we have more than 71% chance for rate cut. Why we have this chance for the rate cut? Let me review once again the data. The GDP fell by 0.5% in the first quarter. Look at here, the 2 days data. That was yesterday's data. 2 days data. What 2 days data says? It says that personal income fell by 0.4% and personal spending fell by 0.2%. These data and these numbers telling us that, oops, sorry, it's a little bit, yeah, personal income fell by 0.4% and personal spending fell by 0.1%. These data means that the labor market is weak. We have a weak labor market, GDP falling by 0.5%. Yeah, this is inflation a little bit higher than expected, but still the GDP growth is GDP growth also getting more concerns. Oops, here's the September. So for the September, yeah, here's the CME Group. CME Group FedWatch tools now gives more than 71%, was now it's getting slightly more, 73% chance for the rate cut in September. So at least 25 basis point rate cut is expected to be seen in September meeting, which was a little bit lower, like around 50% chance for that. Now we have a more chance for the rate cut. So which means Federal Reserve is getting more pressure for the rate cut or the dovish policies. How that policies and expectations can affect the markets. Let's check the charts. So this the US dollar chart. US dollar is moving in a downtrend in the several weeks. It's like third week in a row. So what we can see here, overall downtrend is still continuing, but rate cut gets more chance, which means lower rates, which means less demand for the US bonds, which means weaker US dollar. But at the same time, we know that these data means that economy is getting weaker. Even though we are counting right now on more rate cut for September, which is supposed to be positive for the stock markets, but that positive news comes from the negative or weak that economic data, which means that they are getting a little bit more, they are giving more pressure on the economic growth, which means that the economic growth will get weaker. Even thought the inflation, even thought the interest rate is coming lower, expected to be lower, and that means that we will have cheaper money, we will have more money in the market, we will have easy money, actually, we can say, but more easy money in the market, less dovish policies, less hawkish policies, the market getting more a little bit dovish policies and can support the stock markets and the money market generally. But all these numbers comes after the weaker economic growth, which again is not a positive for the stock market. So the stock markets will get, even thought we have a more chance for the rate cut in September, the stock markets will get under pressure because of this negative economic growth, which means US dollar, while these data are negative for US dollar index, and it's not the positive for sure for the dollar index, but the downtrend can little bit can take a pause here, because money flow takes out from, I mean, the stock traders and the investors, they will take their money out from the stock markets as they are getting more concerned and the worries about the further economic growth and the further stock markets growth. So demand for the dollar index getting slightly higher. So the dollar can get slightly higher. We can expect the dollar index between 97 and 100 mark for the next 2 weeks, 1 or 2 weeks, at least until the next Fridays that we have NFP numbers. The dollar index would be around between 97 and 100. The gold While the initial reaction is the negative for these, but at the same time we have a weaker US dollar, we have a weaker stock markets, and we are expecting a little bit more pressure on the stock market, which means that actually the gold can get a little bit pressure because of the weaker, lower risk in the markets as well, because the geopolitical risk has been increasing in the previous weeks and now it's getting slightly less, but still the weaker stock market, weaker expectations for the stock market can increase the demand. So any correction for the gold can increase the buy opportunities, not any sell position, as long as it's trading around above 3,220. As for the energy market, the weaker US dollar can, slightly weaker US dollar can support the oil and energy market, but at the same time, we have the weaker stock markets, we have the weaker economic growth expectations, which is not a positive for the oil. So about the oil, we are not positive. Even though we are not so much negative as well, but we are not positive about the oil market. So S&P 500 and other stocks, Dow Jones, Nasdaq, generally we are negative about these data because of the mentioned reason that I told earlier. About the gold, we can say that we have to find the more buy opportunities based on the weaker expectations stock markets. As for the dollar index, as mentioned, that these data they mean that the U.S. economy is getting weaker. With weaker economy, we cannot expect a stronger dollar. But at the same time, money flows out of stock markets, which means that the more demand for the dollar index can be. So the slight movements around 97 and 100 markets still, which dollar is expected to be seen. As for the cryptocurrency market, for these data, they are not positive for the risky markets, risky assets. So which means it shouldn't be positive for the crypto as well. But it's not such a negative data for the crypto market, but couldn't be the positive. Same something like dollar index. So I mean that the down, even if we have the downtrend, it can be softer, but we cannot expect these data to move the dollar, to move the US dollar index. Same for the cryptocurrencies, especially for the Bitcoin higher. Yeah, that was the data and market reactions. If you had any other question, don't forget to write in the comment section. I'll try to get back to you as soon as I can. Have a good time. Bye-bye.